A $60 billion crypto empire unraveled in a matter of days. The question is how a token built to hold its peg triggered a run that exposed hidden fragilities across an entire ecosystem. At stake was more than a glamorous experiment in decentralized money. The promise behind Terra-USD, known as UST, was stability without traditional collateral, a digital dollar that didn't rely on treasuries held at a bank, but on code, incentives, and a sister token called LUNA. The pitch landed at a perfect moment. Yields across crypto were fading after an exuberant cycle, and millions of retail savers were looking for safe, high-return parking spots. Terra offered a narrative of engineering elegance wrapped in a friendly storefront. That storefront was Anchor, a savings protocol that advertised eye-catching yields on UST deposits and framed them as predictable income rather than speculative roulette. When the peg cracked, the damage ricocheted from retail investors to trading desks to market-making firms, turning an academic debate about algorithmic stablecoins into a live policy problem. The cast was compact and charismatic. Terraform Labs, a Singapore-based company led by Do Kwon, sat at the center, designing Terra's two-token system and promoting an ecosystem of apps. The Luna Foundation Guard, or LFG, acted like a reserve manager, accumulating crypto assets that could be deployed to defend the peg under stress. Anchor's team and backers served as the customer-facing engine of demand, making UST useful by paying a high rate to hold it. On the other side stood a quieter group of skeptics, risk managers at funds who warned about reflexivity, on-chain analysts who flagged concentration risk in Anchor deposits, and developers who had watched prior algorithmic designs fail when redemptions surged. Regulators and prosecutors were not yet on stage, but they were already watching from the aisle, alert to the growth of something marketed as stable. The timeline matters because design choices met a specific macro backdrop and produced a classical run. UST's footprint swelled through late 2021 and into the first months of 2022 as Anchor's headline rate drew deposits. Liquidity looked deep where it needed to be, until it wasn't. By early May 2022, withdrawals accelerated from Anchor, and market makers leaned harder on the mint and burn arbitrage that tied UST to Luna. As the peg slipped, volatility bled into Luna's price, making every subsequent defense costlier. Reserve deployments aimed to restore confidence, but the window for a credible defense was shrinking. In the span of a week, a manageable deviation became an accelerating spiral. More selling forced more Luna issuance to absorb redemptions, which crushed Luna's price further, which demanded even more issuance. Order books thinned, spreads widened, and the feedback loop ran hot. Under the hood, Terra's mechanics were elegant on paper and brittle in stress. The system relied on a conversion rule. Holders could always swap one UST for $1 worth of LUNA, and the reverse. In calm periods, the arbitrage kept UST close to its peg. If UST traded at a discount, buying it and redeeming for Luna at par created profit and nudged the price back up. The trouble began when a large quantity of UST sought redemption at once. Each redemption required minting new LUNA to satisfy the value promise. The more Luna that was minted, the larger the supply overhang. The larger the overhang, the lower the price. The lower the price, the more Luna had to be minted per unit of UST redeemed. In a run, the stabilizer became an accelerant. There was no hard collateral backstop, only incentives and a reserve strategy that depended on deploying liquid crypto into an increasingly illiquid market. When reserves moved to support the peg, they signaled stress rather than solvency, and sophisticated traders stepped aside or positioned for further declines. Money flows and incentives amplified every weakness. Anchor's high, mostly subsidized yield was the demand engine. It turned the key performance indicator into deposit growth rather than risk-adjusted sustainability. To maintain the headline rate when organic earnings fell short, someone had to fund the gap. Backers did so while markets were buoyant. Once the cycle turned, keeping the rate meant burning runway quickly. On the trading side, basis strategies and carry trades grew around UST's perceived stability. Leverage was not always obvious on balance sheets, but it existed in assumptions. Market makers warehoused inventory on the belief that redemptions would stay orderly, Quant funds modeled peg deviations as mean reverting. Retail holders treated the rate as safe income. Fees and token incentives rewarded participation, but did not price systemic liquidity risk. When that risk arrived, the fees vanished while liabilities remained. Controls that should have slowed the spiral either failed or were never designed for a true run. Risk dashboards likely tracked anchor concentration and curve pool imbalances, but tripwires were calibrated for volatility, not insolvency via reflexive issuance. Governance could pass proposals to tweak yields or modify parameters, yet governance was too slow for a live run. External audits focused on smart contract correctness rather than macro liquidity resilience. Public disclosures describe reserve strategies at a high level, but in a run, the market needs granular, real-time facts. Size, composition, and conditions for deployment. An architecture that promises stability via arbitrage must assume arbitrage. Capital remains available even as spreads blow out and inventory risk soars. That assumption collapsed first. The defense playbook revealed deeper structural fragilities. Liquidity in the core UST pools became unbalanced, signaling that passive instruments were no longer absorbing flow. The more reserves were mobilized, the more it looked like a finite war chest, facing theoretically infinite redemptions. Price-sensitive liquidity demanded wider spreads. Inventory-sensitive liquidity demanded balance sheet space. Both were scarce during fast markets. In that environment, even a well-timed injection struggles, because it invites adverse selection. Sellers wait for support, then sell into it, requiring even larger deployments to achieve the same effect. The reserve model that appeared robust in slides could not change the reflexive math of mint and dump under stress. Legal and policy scrutiny accelerated as the aftermath moved from on-chain to agencies and courts, with steps recorded up to the end of 2022. In South Korea, police and prosecutors opened investigations into Terraform Labs after the implosion, rattled domestic investors, and triggered complaints probing potential violations of capital markets law and whether marketing claims misled the public. In the United States, the stablecoin debate that was already active at the Treasury and the Federal Reserve gained urgency as UST's failure highlighted the difference between over-collateralized and algorithmic designs. Securities and banking regulators examined whether certain tokens amounted to unregistered securities and whether yield programs resembled deposit-like products without prudential oversight. In Singapore, the Monetary Authority emphasized consumer protection concerns around high-risk crypto products and the need for truthful marketing. Across jurisdictions, agencies signaled that calling something decentralized would not immunize it from laws against deceptive practices or unregistered offerings. Up to late 2022, the record shows investigative steps, policy speeches, and initial civil actions, while criminal probes mapped flows of funds and the substance of disclosures. The victims were many and diverse. Retail savers who parked life savings in Anchor, believing they had found a safe harbor, faced abrupt, near-total losses. Startups built atop Terra's rails saw treasuries evaporate as UST and LUNA collapsed. Funds that had warehoused UST or liquidity provider positions discovered that what looked like low-volatility basis trades were correlated bets on market confidence. The reputational fallout reached far beyond Terra. Trust in the broader stablecoin category suffered, even for designs with robust collateral. Market makers widened spreads across tokens, and developers building consumer-facing products with predictable dollar rails encountered a winter of skepticism. In traditional finance, observers saw familiar fingerprints, confidence-sensitive liabilities, moral hazard embedded in subsidized yields, and an incentive to grow fast before the music stopped. The money trail clarifies the incentives. Anchor's rate attracted deposits because it was simple to understand and easy to market. But simplicity masked a subsidy. When rates in the broader market fell, maintaining a double-digit return required external support. That support tied the system's stability to the patience and resources of backers. The bezel, value that exists only while confidence lasts, grew with every new deposit chasing the rate rather than utility. When confidence broke, the subsidy could not convert to solvency. The lessons are unglamorous but durable. Yield is a price for risk, not a free lunch. If a stable asset pays a double-digit rate simply to exist on a platform, the platform is buying your confidence. Convertibility at par is not the same as solvency at scale. Any design that stabilizes price by expanding a correlated risk asset during stress invites a death spiral when redemptions spike. Transparency must be real-time and specific in a run, not post-hoc and high-level. The market will mark to skepticism if it cannot verify reserves and firepower. Diversified demand beats subsidized demand. If a single protocol accounts for most of a token's utility, the token's stability is hostage to that protocol's economics. And jurisdictional reality cannot be papered over by code. If a product behaves like a savings account or a security to end users, expect banking and securities law to appear when things break. For viewers, the due diligence signals are practical. Treat advertised yields above a conservative benchmark as a red flag that demands a clear source of real cash flow, not just token inflation or treasury subsidies. Read the redemption promise literally. Ask who takes the other side in size during stress and what their incentives are when the peg wobbles. Look for concentration risk in sources of demand. If most usage is parking for a rate, not transactional utility, your counterparty is a subsidy. Demand proof, not promises, about reserves, audited, frequent, and detailed. And when a design claims it can hold a peg without hard collateral, assume your exit depends on someone else's willingness to buy newly minted risk at the worst possible time. If you followed this story because you hold crypto or build in the space, the takeaway is not to abandon innovation, but to tighten the discipline. The experiments with money will continue, and some will be robust. But every design that promises stability owes its users boring, bank-like assurances, conservative collateral, shock-tested liquidity, and disclosures that stand up in a courtroom as well as on a conference stage. The Terra collapse didn't invent these rules. It reminded everyone that markets, old and new, still run on confidence, and confidence must be earned long before the run begins. If this breakdown helped, share it with someone who needs the warning, and consider subscribing for more deep dives into how finance really works, beyond the hype.